Welcome, trader. This is Steven with TMT. No pain, all gain. Now let's trade some knowledge. If there is anything that speaks volumes about stock trading, it's volume itself. Volume represents the number of shares traded over a specific period of time. That time period could be as short as a minute or as long as a month. The more shares traded, the higher the volume. The less shares traded, the lower the volume. As you can imagine, it's the bigger, more popular companies whose shares get traded more often. Stocks with higher trading volumes benefit from increased liquidity, tighter bid-ask prices, and in general exhibit more predictable price movements. Shares of small, unpopular companies don't get traded nearly as much. This low volume results in poor liquidity, a wide bid-ask spread, and exposes the stock to manipulation and pump and dumps. This is characteristic of what's called penny stocks. But let's gear our focus on how volume is used in the trading world. Traders see volume as the pack behind the punch. That is, volume gives meaning to the price action. The more volume, the more significant the price action. Traders will use volume coupled with price action to form models and perform studies in hopes of predicting the future direction of the stock price. These models are a part of a process known as technical analysis and are essential to becoming the modern trader. But since volume is such an important piece of raw data, it's equally important to know where it comes from. The majority of volume in the stock market comes from large institutions, funds, and algorithmic-based machines involved in high-frequency trading. Let's call this group of traders the insiders and refer to individual traders as outsiders. Understand that insiders have a different approach to trading than outsiders. This is for a number of reasons. The amount of capital they trade is greater. They trade with other people's money. Their goals, incentive, and risk tolerance differ. And most importantly, since they are the volume, they cannot use volume as an indicator in the same way outsiders can. In fact, some would say outsiders have an easier time at analysis since they can piggyback off the insider's volume. With so much volume, insiders have to be smart about how they accumulate or distribute shares. Their goal, like other traders, is to enter or exit their position at a specific price point or price range. But since they're trading so many shares, executing such a position all at once is usually not possible and not in their best interest. This is because there would have to be a trader or traders looking to take the opposite position, trading an equal amount of shares and at the same price range in order for the trade to be executed. What must be done instead is something called block trading. The insiders, typically through a third party, will execute the trade in small blocks in a given price range over a period of time. Not only does this help them enter or exit their position entirely, but it lets them do it without drawing attention. Spikes or big changes in volume draw a lot of attention to a stock. Other insiders or outsiders may notice the spike in volume and say, well, the cat's out of the bag now, I gotta get in, and join in on the buying or selling frenzy. With this additional trading volume, it'll be much more difficult for the insider to execute their position at the price they were hoping to. But whether you're an insider or outsider, it's clear that volume can lead to answers. The ability to analyze volume is both a skill and an art, but absolutely essential to trade stocks successfully. Volume is the trick to the trade, and mastering it will bring you one step closer to becoming the modern trader.